Hey everybody, it's Friday, October 1st, 2021, and I've got a special presentation for you tonight. We're going to be covering several topics, and this is also going to be an investment presentation for a company that I like. First of all, we're going to talk about all of the contagions going on in the world briefly and why that's going to be bullish for gold and silver heading into the fall timeframe. Of course, we also have the love trade, which we'll talk about. Then I'm going to be talking about the stock market performance over the last month and why it's negative due to all these programs. And then I'm going to compare a couple of investments in the gold space that you may want to take a look at. I'm going to compare a royalty company versus like the GDX, an index of the miners, and show you which is more positive in this environment. So as you're thinking about your investments going forward in the next 4 to 5 months, you have some different ideas to think about. So we're going to start off with what's going on in the world. So as I'm reading the news now, we've got a massive energy crisis brewing in both Europe and in China. I actually just got off of recording a video with Liberty and Finance on this very subject that you'll see go out tonight at 9 p.m. Eastern. But more on this. From my perspective, in Europe, you're having, and in the UK, you're having a major petrol shortage or a gasoline shortage. I just got off with Daniel last night talking about the Perth Mint in the video entitled Perth Mint, We Know What You Did Last Summer, where we talked about before the video offhand when we were preparing for it, how he has a major shortage of gas and it's getting harder for him to get gas to go to work. So he's having to work remote because he literally cannot drive to work. And he's a director in his business and they like to have the directors there, but he just can't find gas. And he said there's shortages for towns and towns over, a gasoline shortage. And there's also rationing of gasoline. And they're also worried about their grid power. In China, they're in a massive emergency where China has just reestablished some coal plants that they had turned down to reduce pollution because they did not have enough energy to meet their rising demand. And what they're doing is blocking energy exports at the border so no energy leaves so they can save all the energy domestically. Then we have the Evergrande situation and the debt situation brewing again. Evergrande is a massive mess. It looks like the Chinese government is not going to completely bail it out, although they have been injecting liquidity in their system all year long and are injecting more liquidity as a result of the Evergrande news to try to keep that Evergrande from the contagion from growing. If you haven't been watching the news, Evergrande is the largest high yield or junk bond issuer in China, and it's the second largest overall debt firm or financial firm in China, which is the second largest economy in the world. So this could be potentially a Lehman type of event. But the way that China's handling it is they're providing liquidity, not necessarily bailing out Evergrande, but they are asking for help with Evergrande, people that are within China to assist the company in a way so that that contagion doesn't spread. Evergrande, for its part, is basically apparently only paying back the domestic borrowers, but they're not paying back anybody outside the domestic sphere. And they've already missed bond payments twice. Another news today that they missed it twice, but they're trying only to pay a portion of that. They've also threatened their employees with taking on some of their real estate projects incomplete in lieu of their bonuses, or that they wouldn't get their bonuses. So a lot going on in Evergrande, but that debt issue seems to be growing more contagious across the world. Of course, last year, Chinese had some issues with some state-owned enterprises. So we've got that situation going on. Here in the States, we had the Fed jawboning about tapering their bond asset purchases, and also maybe next year, more governors want to pull forward interest rate rises from 2023 to 2022 and next year. So that has spooked the market a little bit. All this negative news, as we'll see in a moment, has greatly affected the stock market. So we're going to show you the general stock market. We're going to show you investments in gold equities and in royalty companies. And we're going to talk about one royalty company in particular that we like. The reason we're doing this is to provide you a way to offset that systemic risk. We are a risk management firm. Essentially what we do is we manage our own financial risk and we bring you information to help you manage yours. So we're going to bring you some information to help you manage that investment risk going forward. All right, so on first to what we got going on in the stock market. The stock market did very well up until about September when all this negative news started coming out. Then all of a sudden you can see the pullback. So there's been quite a pullback. There was a pullback in the IXIC from a high of 45.35 now to about, what's that number, 43.17. You've seen it fall down quite a bit, about 4 or 5% here in the last month. You've seen the Other markets as well. You've got the Dow Jones Industrial and the S&P in here. They're all struggling a bit. The stock markets are struggling through all this negative news. Now, this isn't a massive pullback. It's on the order of about 5-6%. It's up a little bit today. A lot of these are up about 1% today, but it's enough to make you wary that if you're holding a bunch of generalized stocks in your portfolio, as this systemic risk continues to get worse, which it is, and it starts to spread, which we believe it will be, just having regular stocks may not be the best idea. Let's go to a stock chart with some other options on it. So we have those major stock market indices, Dow Jones, S&P, Wilshire, so on and so forth. And those are represented by the blue, the pink, and the purple lines down here, the two purple lines, the Wilshire and the S&P. And you can see that they've been relatively, for about 6 months, they've been almost range trading. Now have gone up just a little, they've risen a little bit in the last 6-7 months, about 10-11%, but it's been just a sort of slow gradual rise, and okay rise. But they're starting to tamp down here on the back end in September. Whoops, we'll go back to that 6-month chart. Tamp down a little bit here. In September, you're seeing them start to fall. And if that contagion spreads, these stocks could crash. Well, we also have the GDX, which is the one of the big gold mining indexes that looks at gold majors. And that has trended down as well, even worse than the regular stock market. So as the gold price has fallen off, this general basket of major gold equities and mid caps as well has fallen off as well. So you can see it reached a level about 4.9, I want to say, on May 17th. That was a high for the year for the GDX. And then it's fallen back down to a level of about, if we can get that number, that's about 5.2. Is that the right number? I'm sorry, the high was 5.0 there. I'm not getting accurate readings on the chart. I don't know why it's not working, but you can see it's been a precipitous fall. It's down about 9% since its high in May, I guess, overall. So it's fallen about a little over 10% on this chart. So if you're going in and along with gold and silver, so gold and silver have faded a little bit over the summer. The GDX has faded a little bit over the summer. Now there is a gold investment, however, that has done very well, and that is GROY. That's Gold Royalty Corp, which is a company I would be talking to you about. I'm going to talk to you in general about royalty companies. I'm going to talk to you about why I like gold royalty. It's outperforming the major stock indices dating back to March. You can see a nice little spike up, but this is its nice range trade, a gain of about 39.14% this year, dating back to March. Even at a time when gold is falling, gold equities are falling, and the stock market has started to retrace its gains for the year. GROY, Gold Royalty Corp, has done very well. Why is that? Well, royalty companies have some advantages over the metals and the stocks. Over the metals, namely that as long as the metals are priced high enough so that gold companies get positive revenue for their gold produced, that revenue results in production for those gold companies. As long as those gold companies are producing, the stream and royalty deals that Gold Royalty Corp has basically afford them a certain percentage of income. So they get a certain percentage of income as long as gold companies are producing, but without having to pay operations costs and things like that. And usually they get the gold ounces in the ground for cheaper than you could buy them in the market, quite a bit cheaper for providing that upfront financing. So royalty companies have a lot of advantages over the individual gold equities as represented by the GDX. They don't have all the operational risk, and they don't have as much of the pricing risk in the market. They're going to make money as long as they're producing gold and silver. Here's a nice presentation from U.S. global investors on why they believe in royalty companies. So what is a royalty company? If you've never seen me do a royalty company review, you may kind of want to follow along. I'm going to give you a basic outline. Essentially, it's a precious metal royalty company, serves as a specialized financier. So they don't actually produce the gold, they're a financier, the financial function in the market that helps fund exploration and production projects for cash-strapped mining companies. So look at the GDX. Is there fund flows going into the gold miners right now? Not as much. It's been a little weak the last few weeks and overall this year. The gold royalty company steps in and says, we'll give you some money up front for future production at a discount, and that's how they make their money. It receives royalties on whatever the project produces or rights to a stream, an agreed upon amount of gold, silver, or other precious metal. We consider these companies to be the smart money of the gold space for a number of reasons. U.S. Global Investors is a major investment firm. They write on Seeking Alpha, much like I did for many years. And I know Frank Holmes, for example, who works with them, and they're a pretty reputable outlet. And here are their 4 reasons. The top reason for liking the royalty companies is because they have a robust business model that allows them to potentially generate revenue when the prices gold is both rising and falling. Case in point, look at the chart. They're doing very well, up 39.6% over the year, when gold has been falling as of late and has not retraced back to its last year's high or anywhere close to it. It's about $300 something below it. And the basket of gold miners is down. Gold royalty is still up, and this is why. The price of gold and precious metals can be highly volatile, which is why royalty companies set fixed prices for mining output. So they set their contracts ahead of time. So regardless of the prices going up or down, they're going to make their money. That's why this gold royalty company has done so much better than the general market or the GDX. Makes sense? Reason number 2, since royalty companies aren't operating mines themselves, they aren't responsible for huge infrastructure and operating costs. They don't have to take on debt or dilute shares in order to finance their operations. They take on very little debt relative to producers, making them better allocators of capital. When you're a better allocator of capital, you have higher end returns. Reason number 3 to like royalty companies, they tend to have high revenue per employee, again, because they don't incur the cost of running the mines themselves. A bunch of financial guys that are, and some geologists as well, usually they're looking at deals and doing deals, but they don't run the mine. They don't have to have on-site personnel and those types of things. In fact, they have some of the highest revenues per employee of any type of company in the world, even higher than some of the big banks and financial entities. That's why royalty companies do so well, because they have lower employee costs, no big capital costs. They set their prices ahead of time and they outperform the market. They outperform the stock market and the miner basket. Aha, royalty companies is a good idea if you're looking to get equity representation in the gold space. Wheaton Precious Metals, the largest royalty name with just 35 employees, have 21 million revenue per employee in the second quarter of 2019. 21 million in revenue per employee in a single quarter in 2019. That's amazing. What other business has that potential for that kind of revenue and that overall kind of profits? Reason number 4, miners are highly dependent on their own projects to generate revenue. On the other hand, royalty companies hold highly diversified portfolios of mines and other assets, helping to mitigate concentration risk in the event that one of the properties stops producing precious metals. So one of the reasons royalty companies out producing, if the gold price falls here, some of these companies may have to pull back production, the ones that have less profit potential per ounce produced. But the royalty companies like, well, as long as you're producing, you know, we're getting our money, and the ones that have lower cost structures, we're always going to get money because they're always going to have lower costs than the gold price. So that because they have a mix of different competencies and different companies when they're in a portfolio, they're going to make money, gold price high, gold price low. GDX and the miners are doing well. GDX and miners aren't doing well. They're still making their money. That's the advantage of a royalty company. By owning shares in a royalty company, an investor has exposure to several other companies through royalties and streams of metals. Some royalty companies own streams on oil deposits. So all types of minerals and metals you can have royalties on. But gold's a great one because how many gold companies are there? But think about all the investment dollars that go into gold. Gold has been the most explored for resource in history, even more than oil and gas. So you know there's going to be tons of projects to pick from, tons of companies to pick from. That's why gold royalties tend to do so well. And GROY is basically proving that. All right. Now we're going to dive. We've made the case for why getting into the gold space is good with global contagion, and that global contagion increasing at the same time that you have the love trade and the traditional seasonal trade for gold and silver, both going to drag the price up of gold and silver. We expect that through the fall and early spring, at least, maybe onto the late spring. Then we've talked about why the royalty companies as a whole do better than general equities and returns, and do better than a mix of mining equities as well, and the reduction of risk, and the 4 reasons for that, you know, as provided by U.S. global investors. Now let's talk about the company I want to talk about. I've actually got a target for you. Now, for those of you that may not invest in some stocks and things, pay attention to the rest of the presentation, because this may convince you that you want to get some exposure here. And those of you that invest in equities, there's nothing wrong with that, invested in the gold stocks and the silver stocks. But think about a royalty company. You may want to reallocate some of your capital or some of your new capital into a royalty company because of the type of returns you're going to get. It tends to do better during times in which the rest of the market is seeing some stress. And that's one of the wonderments of it. So Gold Royalty.com, let's give you goldroyalty.com is the website. Let's give you the tickers. It's on the New York Stock Exchange under GROY. That's a major US stock exchange. There aren't a lot of gold related equities on the New York Stock Exchange. This is one of them. It's on the Toronto Stock Exchange Venture under RZZ and GZZ as well. And you'll see here that there have been some merger and combinations of royalties to make this really big portfolio. which is going to make Gold Royalty a pretty massive company with a lot of de-risking, a lot of jurisdictional de-risking, a lot of any sort of project closure de-risking, a lot of de-risking when you have a big portfolio. And not only that, but they're going to be getting money from their streams for a very long time. They also have no debt and 43 million in cash on the books. All right, this is all the royalties that they have. 191 royalties, 6 royalties on producing assets, 7 royalties on assets in development. I'm right here in the presentation. 14 assets under feasibility or PEA. That's where they're trying to figure out whether they're going to do the mine decision to build. So these are coming down the pike. 15 resource stage royalties, which means they've got a resource, but they haven't done their PEA or PFS yet. Some exploration ones in early stage. So they've got an absolute ton of stuff in the pipeline. So look at how well they're doing with the ones that are produced, the 13 that are produced, or I'm sorry, the 6 that are producing and the 7 really close to it. They're still smacking the heck out of the general stock market and the basket of just general indexes. Okay. But look at all the ones they have on the pipe. Another 14 that could be moved up to here to assets and development, 15 that could be moved over here to feasibility soon, and 149 that are in some stage of exploration. Oh my gosh, their portfolio is absolutely going to explode over the next few years. They're already doing well. What happens when some of this stuff starts to come on? So they have 3 in Alaska, 3 in Idaho, 3 in Oregon, all very good districts, 77 in Nevada, a premier district here in the US. Nevada produces 3% of all the gold produced in the world, and the majority of gold produced here in the US as well. It is a premier gold mining district. It's also a premier silver mining district. In the Northwest, 5 royalties. Ontario, 19. Ontario is a tier 1 district, according to Fraser Institute. Quebec, 71. New Mexico, 2. Then they've got some South American exposure, 1 in Peru, 3 in Colombia, and 4 in Brazil. So geographically, very good jurisdictions overall. So relatively low jurisdictional risk across their portfolio. That means jurisdictional risk is not going to crater out this stock over time. They're not going to super high risk areas and just loading their portfolio. They've got really good areas that they're doing business in. Malartic is one project, a generational asset where we demonstrate at least several decades of mine life according to Yamana. Annual production is 700,000 ounces of gold. AISC well below the industry average, sitting at $800 to $900 an ounce. Located in top tier jurisdiction in Quebec, right here, bam, bam, bam. And quality operators, Yamana and Agnico Eagle. Those that know the gold and silver equity space have heard of Yamana and Agnico Eagle. And it's a pure play on gold, and they have 3%. Gold Royalty has a 3% NSR over the underground project. So here is their projected revenue. They're projecting based upon this portfolio. Let's go back to the portfolio. Based upon all this over here, the ones in development, the ones that are going feasibility, if all that goes according to Hoyle, this is the cash flow that you're going to see increase to 2023, 2024 and beyond. The forecasted revenue is going to continue to go up. And what we think is going to be a rising gold environment because of macroeconomic factors and where the stock should come down. Now the GDX and the other basket of gold equities should do better, but I think this one, being the royalty model, is going to do even better. And it's going to outrun both the GDX and the 𝙂𝙊𝙇. So those of you who think you're getting leverage in the GDX and 𝙂𝙊𝙇 and the individual equities, you are, but you're getting leverage here, but you're also getting safety, spreading risk out, de-risking your portfolio. So if you don't want to have to go and look at 60 different stocks and figure out which ones, you could grab a royalty company and then a few of your favorite stocks like Gold and Silver Tiger, for example, and build that all into a nice, a lot safer and balanced portfolio without having all the headache of following 30 different Twitter accounts and reading news every day for all these companies. And if you want to do that, it's okay. But a lot of people are like, you know what, Rob, give me some good ideas and let me chew on those. All right. So more on the company. They got a ton of maps and things here of all their different projects. It's all good stuff. Here's where I want to show you what makes sense. When you're getting involved in a company, who are they running with? Who are their partners? Okay. Who's, in life, what is so important in any relationship, who you running with. They've got Agnico Eagle, Yamana Gold, First Majestic, Barrick, Newmont, Gold Mining, Inc., Monarch, Coeur Mining, Wallbridge, SSR, Rex, Alamos, Fortitude, Gold Standard, Fior, and Rawhide Mineral. So they have an absolute ton of good quality names. Who you're running with? They're running with the best in the business. And on governance, we choose to partner with operating companies that prioritize industry-leading environmental, social, and governance practices. So they're looking at ESG in this portfolio. A lot of these companies are known for their ESG practices. So that's important. Why? because it reduces operational risk of individual mines and jurisdictional risk. Because why? Because governments want this. Whether or not you personally believe in ESG, the governments do, the local NGOs, non-government organizations do. They watch all these mines. And so if they're partnering with companies that have ESG programs, it's less likely to have any sort of unforeseen mine closure, any sort of government crackdown or revocation of permit. It de-risks a lot of the jurisdictional and operational risk of their projects so that you get this kind of return. Okay, that's important. Gold royalty pro forma snapshot. So the commodity mix is 88% gold, 11% copper, 1% silver. It is very almost pure gold. It's got 42% Quebec, premier mining district, 30% Nevada, premier mining district. Nevada is like one of the best, if not the best mining districts in North America. Other America is 28%. So very high quality mining districts, de-risking that jurisdictional risk. Portfolio stage split based on attributable resources, 50% in development, 22% doing the preliminary economic analysis, 22 producing, exploration and development. So look at this pipeline of resource development and feasibility. That's an additional 72% that's going to come on in the next few years, 3 to 4 to 5 years, that's going to increase that revenue. So they're about to grow in terms of ounces produced, negotiated at good market deals ahead of time. That's just going to balloon up their balance sheet. That's the benefit of a gold royalty company. So in any case, the pro forma of the combined company, market capitalization, 745 million, average daily traded, got a lot of shares, net cash, 43 million. When the two companies came together, also have total royalty and stream 191. So they're beating the pants off of all these other royalty companies in terms of market cap, number of royalty streams, volume of the stock trade if you want to get in and out or set your positions, and net cash in order to operate. So they're at the top. Now they've got a huge names on here. David Garofalo is the chairman and CEO. He was CEO of Gold Corp until its merger with Newmont, president and CEO of 𝙁𝙊𝙇𝙍𝙬 Minerals. John Griffith, former head of Bank of America's Metals and Mining Investment Banking. Josephine Mann, CFO of Uranium Royalty Corp, former partner with Ernst & Young, company I work for. Amir Adnani is an entrepreneur named Top 40 Under 40, is here as one of the directors. Ian Telfer, chairman of the board, former chairman of Gold Corp and World Gold Council. I mean, we're talking premier people in the gold space on the board and as management of the team. So we're not worried about management. The number one thing you want to look at before jurisdiction, before price, before anything on either a gold equity or a royalty equity, you want to look at management, and they've got really good management. That's why I like them. So they have a potential re-rating. They could get up to where Franco-Nevada, Wheaton, Royal Gold are. They're down here right now. So as they continue to operate, more of these things come online, and as the gold price rises, they're going to move up. They're going to have a higher P/NAV ratio versus market cap. Okay. What that essentially means is they're going to be better valued. Their P/NAV is going to go up, meaning they're going to have more value in their assets when compared to their market cap. Okay. Which means you have some upside potential. That's what that means. Those of you that came to, and this is very important, comparing P/NAV and market cap. Those of you that came to Silver Symposium in Idaho, I gave a special talk on this where I talked about 4 financial measures for gold stocks. P/NAV and market cap comparison was one of them. This is very important. This re-rate potential for GRC is extremely important. That can bring a lot of investor value. That can really enrich the investors in the company when you can re-rate as you move up that scale. And as you have more projects come online, or in this case, more royalties and streams, it will increase the value to the shareholders based, compared to the position you got on. In other words, the share price is going to rise as you get more of this gold producing. That's a fancy way of saying that. But this P/NAV versus market cap is one of the most powerful financial analysis that you can do of a gold equity of any type. Anyway, a lot of information I just threw at you. One other thing I want to talk about was gold royalty and Abitibi royalties and Golden Valley combined to create a leading growth in America's focus precious metals company. So how did they get 43 million in the bank, 191 royalties, 745, I think, million market cap to basically lead the royalty space? Well, it says here on September 7th, Gold Royalty Corp, Abitibi Royalties, and Golden Valley Mines and Royalties are pleased to announce that they've entered into definitive agreements dated September 6, 2021, pursuant to which Gold Royalty will acquire all of the issued and outstanding common shares of each of Abitibi Royalty and Golden Valley by way of statutory plans of arrangements. Under the terms of agreement, each holder of the common shares will get so many for other shares. In other words, the share transaction. At the close, Gold Royalty, Abitibi Royalty, and Golden Valley shareholders will own approximately 54, 23, and 23 of the company. In other words, they're merging together to create this giant powerhouse in the space with huge upside potential in an era in which we think gold prices are going to rise. So, you know, if you're looking at like a gold equity, nothing wrong with gold equities. If I told you 3 of the largest gold equities are going to get together to form a super company in an era of rising prices, you would say, wow, is that Newmont? Is it Barrick? Who is it? Let me go invest. That's what Gold Royalty has done in the royalty space, okay? And remember, the royalty companies make more per employee and make more per dollar invested, per capital allocated, than do the equities. That's why Gold Royalty is going up on that chart. The GDX is going down as gold's going down. Gold Royalty is still going up and then staying in that space. Even though it's come down a little bit from its previous high this year, it's still up overall, what was it, 38, 39% on the chart? Much better than the general stock index. So even though the Fed's pumping money into the general stock index, Gold Royalty's actually done better. So people say, well, gold's not performing, Rob, and gold and silver, and I have all this angst and people are angry at silver and bullion. When's it going to go up? Have real physical gold and silver in your portfolio. Invest in some of the equities for the upside leverage. In the meantime, stabilize that with a company like Gold Royalty because it's beating the pants out of everybody else. So you don't have to say, why gold? Even though gold is drifting, you know, traded down since it's high, Gold Royalty's done just fine. Benefit of royalty company. All right, so recapping today's episode, we talked primarily about the financial system contagion. We talked about energy issues in Europe and China building up, and supply shortages overall of goods and services around the world. Some qualified labor shortages, the debt contagion in China, which I think is also going to spread to Europe and the US as well. Remember, Europe has about 15 trillion of negative interest debt. They would have debt contagion very quickly, which could tank the euro if that thing blows up. All of that's going to spread to Americas because in the interview you're going to see at Liberty and Finance tonight, 9 p.m. Eastern, that I have with Elijah, I talk about how that happens. I talk about why they're all intertangled. So global contagion, not just in China and Europe, is starting to blow up. And we're getting into the traditional positive season for gold and silver, the love trade in the fall and the winter and the early spring that tends to be the best prices for gold and silver, along with those macroeconomic factors. So all of a sudden you see some pretty good upside potential for gold and silver. And then I talked about why royalty companies are beating the GDX, the basket of general gold equities, and the generalized stock markets, the Wilshire, the NASDAQ, the S&P, and the Dow. Why it's beating it. It gave you the 4 reasons why it allocates capital better, why you don't have to have a lot of employees, you're not taking on operational risk, and you set your prices for gold ahead of time in these agreements that you're going to take on, so you reduce your downside risk. It's like the royalty model is just so powerful. And I've talked about several royalty companies this year, and they've all done better than the general indices and than gold and silver have. So you don't have to say, oh, gold and silver, you know, I'm so frustrated, it's down and I'm going to go to Bitcoin. You can go to, if you want to stay in the gold silver space, go to a royalty company. If you want to rebalance your portfolio, take some profits from some of your other equities and put it in, go to a royalty company. You know, if you already have your fiscal, go to a royalty company. These are different ways to play the market with certain beneficial factors. Now, I'm just giving you this information to help you out, to give you an option. I'm not your financial advisor, you know, but at the end of the day, you know, make your own decision, do your own research. But I think I put a compelling case here that we have some stressors in the economy that's going to raise gold and silver, the positive love trade that's going to raise gold and silver, how the general equities and the GDX haven't caught up to that, how the general equities are going down, GDX has not caught up, it's gone down even more. But that gold royalty company has done very well. GROY has done very well. It's outperformed, and they formed a super company, which is going to become one of the biggest royalty companies in the world. And it has such a big portfolio of projects that are going to be onboarded, and different from a project and mining company. They don't have to spend the money to develop it. So if it sits there and doesn't produce, it doesn't hurt them to the downside. The ones that come on and produce help them to the upside. So they're limiting the here in a nutshell. The only thing that you remember about gold royalty company, you're limiting your downside risk and you're increasing your chances for upside risk. That's the benefit of royalty company. That's gold royalty company. That's the sum for today. Everybody, if you love this type of research, you can support me on Patreon. We're at patreon.com/gold-silver-pros. We have several different tiers that you can contribute for. We will have private content there for members only for you. That'd be high value. I'm about to do the weekly summary here in a few moments for you guys. It's going to cover the last 2 weeks, including some of the information at the conference. And it also, when you contribute, helps us provide this type of content, talking about what's going on in the world, going on other programs, talking about investments, ideas that may help you. All of this, ladies and gentlemen, takes an incredible amount of time and money. And in order to do that, your support will help us do more of this for you. Now, stay tuned for Sunday, because Sunday, we're going to have the Silver Strand Mine Tour. We're going to go look at historic Silver Strand Mine, which Lakewood Exploration is going to reboot. And we're going to look at where they have 30-foot blowouts of silver veins in there. And I'm going to show you how they actually do some of the mining. And I'm going to show you how they drill. So if you ever want to know how that cool stuff works, free video, Sunday, 2 p.m., come back to the channel for that. And of course, next week, we will have more content. I'm doing a very exciting live stream this coming Tuesday with two people you're absolutely going to love. Two brand new people to my channel on a live roundtable Tuesday night, 6 p.m. Central. Stay tuned for that. So much content coming your way. Thank you so much, guys, for supporting the channel. This is Rob Gaines with Gold Silver Pros. Hey guys, don't forget to hit that subscribe button and the bell for notifications, and go to goldsilverpros.com and sign up for the free newsletter so you can get your updates.